Hello everyone, welcome to Module 4 of Climate Risk Masterclass. I am Jai Shah and I am here for the climate risk governance and stakeholder landscape. So we are going to understand that how the stakeholder landscape is working in the climate risk. So if you have come from Module 3 where we unpacked the transition risk in detail, the policy shifts, technology disruptions, market repricing, and you will remember we spent most of the time to understanding the nature of the risk themselves, including the physical risk in module 2 and the theory of the climate science that you have gone through it. So module 4 is where we zoom out to ask a different questions: who is accountable for managing and disclosing this risk, and throughout what frameworks is. So we are going to cover three connected areas. In module 4.1 we look at board and executive governance, how climate gets embedded at the top of an organization. So in module 4.2, we map the full stakeholder ecosystems: investors, central banks, and regulator and ESG rating agencies. And in module 4.3, we will walk through the major disclosures frameworks of TCFD, ISSB S1, S2, and the EU CSRD and the SEC climate rule on the high level introduction. So this is one of the most practical relevant module in the whole series. So let's get straight into it. So before we dive in, here's the quick map what we are going to cover. So as I mentioned, all the basic things about the module. So module 4.1 is about the governance, which is specifically how boards and the risk committee are expected to embedded climate risk into the enterprise. So this is not optional anymore. It's explicitly required by every major disclosure standards. In module 4.2, shift to the external stakeholder landscape. So we will look at what institutional investor actually want from the companies, and how central banks through the NGFS have become a major force in setting a climate risk expectations. And also we will see the how securities regulators like FCA, SEC, and ISMA, EFRAG are moving from the guidance to enforcement, and why ESG rating agency matter even though their methodology divergence quite significantly. And in last module of 4 is 4.3 is where it all comes together in terms of disclosure framework. So we will go in deep into the TCFD, then the ISSB's IFRS S1. TCFD is now no more there, but base of the TCFD, all the other standards and frameworks has been created. EU CSRD, which is the most demanding of the mandatory regimes, and the SEC climate rule from the US side. So the key outcome for this module is being able to clearly articulate who governs climate risk, who is demanding accountability, and how the global standards landscape fits together. So those are three questions this whole module is going to be answered. Let's start with the module 4.1, which is a board and executive governance of climate risk. So the core question here is, what does good climate governance look like at the top of an organization? And increasingly, the answer is being defined not by what organizations choose to do, but by what they are legally required to do demonstrate on that side. So why has climate governance become such a board level issue? So there are three converging pressures, and I want to spend a moment on each because they are coming from very different directions. So the first is redefinitions of fiduciary duty. Courts and regulators are increasingly taking the positions that a director who ignores the material climate risk, and climate is now broadly accepted as a material for most large organizations, and that is a potential in breach of the fiduciary duty. So the client Earth versus Shell case in 2023 is the highest profile example, and shareholders used the Shell board arguing directors were failing to implement a credible climate strategy. So the case was ultimately unsuccessful, but it set a precedent for this kind of litigations. So directors can no longer say we thought about it and decided climate was not our problem. So the second pressure is regulatory mandate. Look at the start box on the right. 85% of TCFD reporters now include a specific statement about board level oversight of climate risk. So that's up from around 40% just 5 years ago. And from 2026, UK is going to mandatory TCFD applies to all large companies, not just premium listed ones. So TCFD, SSBS2, CSRD, all of them explicitly require you to describe how the board oversees the climate risk. Whether you have sustainability policy, but what the board actually does, and all kind of those questions and the frameworks needs to be done. And the third pressure is investor scrutiny. So asset managers, pension funds, insurers, they have started treating board governance quality as leading indicator of how seriously a company manages climate risk overall. So they look at these things like whether there is a board member with relevant climate expertise or not, whether the audit committee reviews climate disclosure or not, whether climate KPIs are linked to executive pay or not, and ESG rating agency that scores governance quality as a sorry component of overall climate risk rating. So weak governance directly affect your cost of the capital, and the 2.5 million FCA fines in UK. I was reading one of the articles that published for after the exposure figure, and a reminder that these are not a hypothetical risk that for any kind of greenwashing. So greenwashing enforcement and the governance failures are active regulatory priorities in the UK as well as the other part of jurisdictions that emerging slowly. So now we have the one of the most useful framework for organizing climate governance within an institutions. That is the three lines of defense model. So most of you in finance and risk management will already know this structure. So the key thing I want to show here is how it mapped directly onto the climate. So the first line in your business units, your trading desk. So your lending teams, your procurement manager, your product teams, they are the ones who own the risk day to day. So in a climate context, that means they are responsible for identifying where physical or transitions climate risks show up in their operations, embedding climate KPIs into their performance target, and reporting climate data up to the second line. So, for example, a property lending team should be flagging the flood risk profile of their mortgage book. And the second line is your risk management and the sustainability functions. The climate risk team, the ESG team, the treasury functions, their job is to design and maintain the enterprise climate risk framework, run scenario analysis by using NGFS pathway. But the challenge when the first line's assessment has been done and ensure the data quality good enough for external disclosures as well. So these are the few challenges to first line assessment and the second line assessment. So this is the typical where the chief sustainability officer is going to be sits, and it's the functions that's grown fastest over the last 5 years. So the third line is internal audit. So this is the critical and often underdeveloped in practice. Internal audit should be independently verifying that what you are publishing in your TCFD or ISSB aligned report actually reflects also the what's happening inside the organizations. Are the process described actually in place? Are the numbers very accurate? Is the methodology is consistent? And the audit committee or the board received these findings directly or not? And above all three lines sits the board and the audit committee, ultimate oversight of the whole architectures. TCFD governance pillar, CSRD and SSB S2 all require you to evidence this oversight structure, not just claim it exists. So those kind of stuff is we have to understand for the first line, second line and third line related the stakeholder assessment. So now this is a slide I want you to study carefully because one of the most common weakness in TCFD and ISSB disclosure is conflicting the board role and the management role. So they are genuinely distinct and both need to be described explicitly. So on the board side, the board oversees and challenges, it does not execute. So the board approves the climate strategy, it approves the scenario assumption, it ensures climate is embedded in the mandates of its committee, particularly audit risk and remunerations. It reviews the climate disclosures before they are published, and increasingly it's linking executive remunerations to climate performance metrics. So that last point is being scrutinized very carefully by investors. And on the senior management side, this is where executions happen. So the exco or the ex committee or management committee develops and implement the frameworks. They are running the actual scenario analysis and presenting result to the board. So they integrate climate into the capital allocations decision uh, and the credit ratings as well. So they assign operational accountability that often to a chief sustainability officer or equivalent, and they monitor the KPIs, scope 1, scope 2, scope 3, emission trends, physical risk exposure, target tracking, etc. So the TCFD principle at the bottom of this slide is really important, and you need to disclose both levels separately. A common drafting error is writing something like the board and the management oversees climate risk. So that's one sentence that satisfies neither requirements. You need to two separate sections describing what board specifically does and what management specifically does. Auditors and regulators are increasingly checking for these distinctions. So those kind of stuff, it is very important on that side. A question I often get is where does climate risk sit within an existing ERM frameworks? And the answer is that it does not create a new parallel system. It gets embedded within the existing one. Let me walk through the 5 steps. Step 1 is risk identifications. You are mapping physical and transitions climate risk onto your existing risk taxonomy. Physical risk, that is heat stress, flooding, sea level rise, typically manifest as operational risk. Property risk or the credit risk, transition risk, carbon pricing, stranded assets, technology shifts manifest at market risk or strategy risk. So those translations into important because it connects climate to language your risk committee and the board already understand. And the step 2, that is a risk assessment. So your score identify risk for likelihood, magnitude, and the time horizon. So this is where NGFS scenario become important for the financial institutions, and there are other scenario that is IPCC and that created the SSPs as well. So you use them to stress test your assumptions across at least 2 or 3 pathways. Crucially, physical and transition risk operate on different time horizon. Transition risk often peaks in the near and to medium term, the next 5 to 10 years, as policy tightens and asset repricing accelerates. Physical risk compounds over the decades. So step 3 is risk appetite, where the boards needs to set explicit climate risk thresholds. For example, we will not hold more than X percentage of our portfolio in asset with high physical risk scores, or we require all new investment to stress test against the carbon price of 100 per ton. Having a named quantified risk appetite makes governance real rather than aspirational. Then step 4, that is a mitigations and response, that capital buffers, insurance product, hedging, supply chain diversifications, transitions planning, and the final steps, that is the fifth step, that is monitor and reporting your KPI dashboard, internal audit cycles, and external disclosures. And this steps loops back to everything we have discussed. The TCFD, ISSB, CSRD, and the national mandates are all outputs of a functioning monitor and reporting steps. So these are the climate risk that integrate into the overall enterprise risk management, and any kind of organizations or the financial institutions can follow the steps and integrate those kind of climate risk into the ERM. Now we move to module 4.2, the stakeholders landscape. So this is about to understand who is driving the demand for better climate risk management and the disclosure from the outside in. So there are 4 main groups we will discuss in detail, but that is first one is institutional investors, second central banks through NGFS securities, also the securities and regulators, and ESG rating agency. So each uses different tools and has a different mandate, and understanding those difference matters a lot. So let's map the whole ecosystem. Before we go deeper into any one part, starting top left, that is institutional investors, that is pension funds, asset managers, insurance companies. Their primary tools are stewardship and the capital allocations. So stewardship means voting at AGMs, co-filing shareholders resolutions, writing engagement letters, capital allocations. That means titling the portfolio away from the company with poor climate risk management. So the key alliances here are the net zero asset owner alliances, the net zero asset management initiatives, and the climate action 100 plus CA 100 plus, which now represent over 700 investors with $68 trillion under management, collectively targeting systematic climate actions from the world's highest emitting companies. In the top right now, you can see the securities regulator. So the FCA here in the UK, the SEA in the US, ISMA in the Europe, SEBI in India. So these are the enforcement authority. They mandate disclosures through rules like CSRD and the SEC climate rule. They investigate greenwashing claims and they review prospects for the adequate climate risk disclosure. They are also increasingly active on enforcement. The FCA's SDR rules and the SEC's greenwashing actions are live example. You can see the bottom left now, the central banks through the NGFS. So we will go deep on this on the next slides. The shortened version is they set the scenario architectures for supervisory stress test and published a guidance that shapes how all financial institutions are expected to model and manage climate risk. Uh, Here, the bottom right, that is ESG rating agency, MSCI, Sustainalytics, CDP, S&P Global. This translate climate risk exposures and the governance quality into the score that directly affect bond pricing, index inclusions, and capital allocations. So the no global standard exists yet, and that divergence is very itself a significant issue that we'll explore. The Network for Greening the Financial System, NGFS, that is probably a single most important body you have never heard of if you are coming to climate finance for the first time. That is founded in 2017 by 8 central banks and now comprising over 140 members, including the Bank of England, the RBI in India, and the Federal Reserve as an observer. Uh, NGFS exists specifically to develop the tools and the framework that central banks and the financial supervisors need to manage climate risk systematically. Its most influential output is the NGFS climate scenario frameworks. So there are three families. The orderly scenario assumes early that decisive policy actions where warming is kept to 1.5 to 2 degree and the transitions cost, while significant, are manageable. The disorderly or orderly scenario that assume delayed inactions that follow by an abrupt policy shift. So this is where you see the highest stranded asset risk because market have not had a time to price in the transitions. And the hothouse world scenario assume the policies remain insufficient where warming of 3 degree or more with severe and compounding physical risk dominating the outlook. So why does this matter for you practically? Because these three scenario families are now the standard reference for regulatory climate stress test globally. So the Bank of England's 2021 climate biennial explanatory scenario used NGFS pathway. The ECB's 2022 climate stress test used NGFS pathway, and increasingly corporates running their own TCFD or ISB scenario analysis are expected to reference or at least be consistent with NGFS. So the 2023 phase 4 that update added a granular country level physical risk projections that covers heat, flood, drought, sea level rise, which are directly useful for asset level physical risk modeling. So if you are working in climate finance in India, the RBI's NGFS membership means this scenarios architecture is coming to the Indian supervisory expectation too. And similarly, I'm just giving the example of one jurisdiction. The other jurisdictions are also part of the NGFS membership. So they are also going to be part of that whole central banks and other requirements as well. So now let's talk about the ESG rating agency. That is also one of the important stakeholders in the landscape of climate risk. So these are the enormously influential. So they shape the capital flows, bond pricing and index inclusions, but they are also genuinely problematic in ways that practitioners need to understand. So the four main ones you will encounter are MSCI ESG. Their AAA to CCC scale is probably the most widely used in institutional investor screening. The second one is Sustainalytics, which is now Morningstar subsidiaries focusing on unmanaged ESG risk and the scores companies on 0 to 40 plus scale where lower is better. The third one is CDP, that is a different, it focus on specifically on companies' climate, water and forest disclosure that running on annual questionnaires process, and its scores from A to F are used heavily in supply chain assessment and by the Science Based Target Initiative. Then S&P Global's Corporate Sustainability Assessment or CSA that fits the Dow Jones Sustainability Indices. Now there's the critical limitations. One, I want you to really internalize that the correlation between the ESG rating from different agencies for the same company can be low as the zero point 0.3 to zero point 0.5. So it can be the different output, different outcomes from the different companies. So that's an extraordinarily low numbers for what's the supposed to be measure the same underlying reality. So for comparison, Moody's and S&P credit rating for the same company correlated at over 0.99. So the divergence in ESG rating is so significant that a landmark 2022 academic paper by Burge, Colbert, and Ricoburn that call is aggregate confusions. So the reason include different scope, different weighting of factors, and different data sources. That what does this mean practically? Companies need to actively manage their ESG rating relationships and not gaming the system, but understanding what each agency is measuring, providing the consistent data inputs through the CDP, the MSCI portal, and the S&P CSE questionnaire, and engaging directly with analysts when scores don't reflect the actual risk management reality. So the EU is now addressing this through the ISMA's ESG rating regulations, which will require rating agency to be transparent about their methodology and the data that source from 2026. So that's a welcome development from the European leading side on the low carbon economy. Now we get to module 4.3. So the disclosure framework, that is where governance and the stakeholder expectations crystallize into the specific reporting obligations. We are going to cover TCFD, ISSB, IFRS S1 and S2, and the EU CSRD and the SEC climate rule. So these are the very broad jurisdictions requirement, and based on that only the other part of the regions develop, and precisely ISSB is going to be adopted by the most of the jurisdictions as per the G20 and the ISCO mandate. How they all fit together, because one of the biggest source of confusion I see among all the practitioners is the assumptions that these frameworks compete to each other. So they largely don't, they nest on those different sides. So the TCFD, which is the Task Force on Climate Related Financial Disclosure, was established the Financial Stability Board in 2015 and published its final recommendations in 2017. At the time it was voluntary, and today it is the foundation of virtually every mandatory climate disclosure regime in existence. So the four pillars are governance, strategy and risk management, and metrics and targets. Let me walk you through each if you are not aware of any kind of pillar. So pillar one, that is governance, which is you need to describe how the board oversees climate related risk and opportunities and how management assess and manage them accordingly. You can notice that there are two separate requirements: board oversight that is distinct from management implementations. An example of good governance disclosure, that is the audit committee reviews the climate risk register quarterly and receive an annual report from the chief sustainability officer on progress against our transitions plan. That's a specific evidence. So that is pillar one. Pillar two, that is strategy. So this is the most substantive pillar. You need to describe the climate risk and opportunity you have identified, their impact on your business strategy and the financial planning across short, medium and long term horizon. And critically, you describe the resilience of your strategy. That is a very important task under the different climate scenario. For example, what happens to your product margin if carbon pricing of 100 per ton in introduce that product? So that's the transition risk stress test, and it belongs in the strategy pillar, and that part of that whole detailed requirements. Pillar 3 will be the risk management. Here you describe the process you use, how you identify climate risk, how you assess their magnitude and likelihood, and how those processes are integrated into your overall enterprise risk management framework. So this is where the three line of defense model we covered earlier becomes your disclosure narrative. The pillar 4, which is a metrics and target, you disclose the metrics you use to assess the climate risk, your scope 1, 2, and 3 greenhouse gas emissions, and the specific target you have set, that including your net zero commitment or the interim milestones, everything, and how you are performing against them. Everything you are going to see in ISSB S2, CSRD, and the SEC rule that builds on these 4 pillars, and learn TCFD very well, so you will find the other significantly easier to navigate on that side. In June 2023, the IFRS Foundation's International Sustainability Standard Board published its first 2 standards, that is IFRS S1. So let's deep dive into the ISSB standard. So this was genuinely significant moment because the IFRS Foundation is the same body that gives us the international accounting standard used in over 140 countries. Sustainability disclosure is now on the same institutional footing as financial reporting. IFRS S1 is the broader standard. It applies to all sustainability related financial risk and the opportunity, not just the climate, but also the biodiversity risk, water stress, human rights in supply chain. These all fall under S1 in principle. But importantly, S1 use the same 4 pillar structure as TCFD, strategy, risk management, metrics, and targets. If you have built your TCFD disclosure properly, any day, any time, any kind of company or any kind of bank or institutional activities that you have done for the TCFD, your S1 framework is largely in place. And S1 also require connectivity with financial statement. Your sustainability disclosure can't exist in a separate silo. So that is why they want the financial statement work together. So they need to link to your balance sheet, income statement, and cash flow projections. IFRS S2 is the climate specific standard. It builds directly on S1 and formally incorporates TCFD. So this is a critical. ISSB S2 didn't replace TCFD. It absorb it. So if a company say they are ISSB S2 compliant, they are also implicit that TCFD compliant. S2 requires scenario analysis. You must assess your strategy resilience under the climate scenarios that consistent with established pathway like NGFS. It requires scope 1 and scope 2 GHG emissions disclosures and scope 3 on a phased basis manner. So it draws on SASB industry specific metrics. So the disclosures expectations differ by sector, and it requires transitions plan to disclosures. You can't just state a net zero target, you have to explain how you intend to get there with interim milestone. So one note on the timing, that ISSB S2 is effective for annual period beginning 1st January 2024, but the jurisdictions adaptations vary enormously. The UK has committed to endorsing the standards. Australia has also mandated them. Many other jurisdictions are in active consultations, but the directions of travel is very clear that ISSB S2 is becoming the global baseline for everyone. So now let's compare the 2 highest profile mandatory regime, the EU's Corporate Sustainability Reporting Directive and the US SEC Climate Rule from the California side. So the CSRD is the most comprehensive mandatory climate disclosures regime currently in force. It was adopted in December 2022 and applies to approximately 50,000 companies at that time. And here's something many practitioners outside of the EU that misses, that it applies to non-EU companies too. So if they have significant EU revenue, specifically non-EU companies with more than 150 million in EU net turnover, for I'm just giving the example, the actual turnovers is now going to be changed because of the omnibus package. A substantial EU presence will need to report that. That means many UK based, US based, India based, any kind of other countries are in the scope. CSRD uses the European Sustainability Reporting Standards, that is ESRS, that developed by the EFRAG, the European Financial Reporting Advisory Group. So the climate specific standard is ESRS E1, and CSRD defining a feature is double materiality, and you have to disclose from 2 angles: the financial impact of climate on your business, and which is that TCFD and ISSB focus on, and the impact of your business on the climate. That second direction is unique to the CSRD and goes considerably further than any other mandatory regime. CSRD also requires third-party assurance, that is limited assurance to start and moving towards reasonable assurance over the period of time. So the SEC climate rule is different beast, and it is different than the EU definitely, but EU is leading into the sustainability, ESG, and climate risk side. So the SEC climate rule is different on adopted uh, in March 2024, but currently stayed pending a legal challenges because of the priorities from the government. It applies to all SEC registrant US listed public companies if they are into California. The required disclosures include climate risk and their financial impact, Scope 1 and Scope 2 GHG emissions about the materiality thresholds, financial statement impacts of severe weather, board oversight, and the scenario analysis if used internally. Notably, Scope 3 emissions were in the proposed rule but dropped from the final rule due to the anticipated litigations. So that's a significant gap compared to the CSRD. So the comparison at the bottom is worth noting is that CSRD is very broader, more demanding, and including double materiality and the assurance process as well. The SEC rule is narrower, but they represent the first federal climate mandate for the US public companies, and that's a significant threshold to have across legal and challenges notwithstanding on that side. So this is the slide I most want you to spend time with because this nested diagram captures the relation between all the frameworks we have been discussing. Think of TCFD as the uh, outmost layer and the voluntary foundations that everyone reference. It's four pillar that commons language of the climate disclosures. So everything ISSB S1 and S2 that sits inside the TCFD, it incorporate TCFD and extend it into the full global baseline standard. SSB is designed explicitly so that jurisdictions can adopt it and build their mandatory regimes on the top without creating conflicting requirements. Inside the SSB layer, you have two jurisdictions regime that's sitting side by side, EU CSRD with the double materiality assessment, ESRS E1 and assurance requirement, and so many of other modules under the ESRS, and the US SEC rule that narrower in scope, scope 1 and scope 2 only, no double materiality, but currently legally stayed. These two are the largest mandatory disclosure regimes by market coverage. So to the right of the ISSB box sits UK mandatory TCFD, which is slightly different in architecture because it's built directly onto TCFD rather than the ISSB, but uses the same four pillar structures that premium listed company have been required to report since 2022, and it's becoming mandatory for large companies, everything. So the key insight at the bottom is the practical takeaway. If you build a robust ISSB S2 aligned disclosures program, you satisfy TCFT, you are most of the way of the SEC rule requirement, and you need to incremental additions for the CSRD. That is mandatory for under the mainly double materiality assessment and broader ESRS coverage and for UK TCFD. So ISSB S2 is the your most effective starting point, and that's not just my view, it's an explicit design intent of the IFRS foundations. So now this table is what I would call the practical translation layer, and I think it's one of the most useful things in the whole module. So the left column shows internal governance practice and the right column shows the external disclosure requirement, and those practice directly that's satisfied on that side. So let me read through them for you. If you have a board climate committee or a standing climate agenda item at board level that directly satisfy the TCFD governance pillar requirement for the board oversight evidence. If you have a management climate risk working group that gives you the process narrative for ISSB S2's risk management disclosures and etc. That covers on that side. If you run internal climate scenario analysis using NGFS pathway that satisfy the TCFD strategy, pillars, resilience disclosures, and it meets CSRD, ESRS E1 scenarios analysis requirements as well. Also, if you have a GHG emissions measurement program, scope 1, scope 2, scope 3 under the GHG protocol that feed directly into ISSB S2's quantitative metrics and the SEC rules emissions disclosures is there, then covers on that point. If you have a net zero transition plan with interim milestone, that's your CSRD, ESRS E1 transition plan that disclosures, and your SSB S2 transition plan narrative that covers on that internal governance practice. And if you think that climate KPIs to executive pay that satisfy TCFD metrics and target pillar and directly address the investors' stewardship expectations around the remunerations, that can be the part of that. So the message here is the governance first, disclosure is second. If your governance is genuine and robust, the disclosure largely writes itself. So the problem most of the organizations having is trying to write the disclosure before the governance practice, and they don't have any kind of committee, board members who are working for the climate risk or the sustainability initiatives, adaptation strategy, mitigation strategies, and they don't have any kind of governance practice are actually in place. And sophisticated investors and auditors can tell the difference that how it's work on that side. So before the final summary, here's your reference map for everything we have covered today under the module 4. So for TCFD, the original 2017 final recommendations report and the 2023 status report are both on the website of fsbtcfd.org. The status report is particularly useful because it shows what percentage of companies are actually reporting against each pillar. That is useful context for understanding where market currently sits. For ISSB, the S1 and S2 standards are freely downloadable from ifrs.org, and there's a substantial library for educational and implementation guidance on the same site. For NGFS, that is the primary source, so the climate scenario portal has all the data, and the 2020 guide for the supervisors is still the best single document for understanding how central banks are approaching climate risk integrations. For EU CSRD and ESRS, that has a full ESRS set 1, including that ESRS E1 climate data on that side. That covers the EUR-LX, has the actual directive text on that side. That is legislative directive text on that website. For the SEC, SEC.gov has the final rule document and supplementary the guidance on that side. For ESG ratings, the ISCO 2021 report on ESG rating provider is essential reading for understanding the governance challenges, and definitely the paper that I mentioned about the ratings related stuff, that how the confusing is the definition, academic treatment of rating divergence is very important. That is Burrs, Colbert and Egoburn 2022 paper. So all of these links are also in your learner document that I'm going to share with you with clickable URL, so that you can read based on your requirements and you can enjoy the learning process. So let's land on the 5 key takeaway from module 4. I hope you enjoy the stakeholder landscape, and now you have idea about that where the climate risk is sitting on the actual organizational stuff, and where you can find your opportunity as well. So the first one is climate governance, that is a board level responsibility. It's not a sustainability team issue. That TCFD, SSBS2 and CSRD all require explicit evidence of board oversight. Then not a paragraph saying that board takes climate seriously, actual evidence of what board does, but you have to do more than that. The second one is the 3 lines of defense framework that apply to climates. Business unit owns the risk and sustainability function design the frameworks, and the internal audit verifies that disclosures are accurate or not. All 3 lines needs to be functioning. The third one, which is very important and my favorite, NGFS provides the scenario architecture that connects central bank stress test, corporate scenarios analysis, and the investor expectations as well. So if you are working in climate finance anywhere in the world, you need to know NGFS scenarios as well. The fourth one, that is ISSB S2, that is global baseline. It incorporates TCFD and designed so that CSRD, the SEC rule, the UK TCFD, all the built on the alongside of it. So you should start with the ISSB S2, and you are most of the way there for every other regime on that side. The fifth one is ESG rating agency that are influential, but their methodology diversions significantly, and companies need to proactively manage multiple rating relationship, provides a consistent data, and engage with rating analysts, not the game scores, but to ensure accurate representation. So that's module 4 complete, and module 5 is going where we get quantitative. So we will cover how the actual measure climate risk, how to run scenario analysis in practice using NGFS and physical risk matrix, including the value at risk, and how to build the kind of scenario analysis that satisfied the TCFD, SSB, or any kind of reviewers on that side. So definitely thank you very much for your time and kind interest attention. I will see you in the module 5. Enjoy this module.